Hi guys, and welcome to Freckle Finance. Now that I have covered the basic types of investments, I thought it was time to start talking about investment strategies. Now, this first strategy I'm going to cover to get it out of the way so that you guys don't do this. This one is called the past performance strategy. So as I said, I want to get this strategy out of the way. This is not a good strategy. The reason I'm making a video on it in the first place is because so many people think that this is a good strategy. Now, they may not have really thought about it, but they'll say, this stock has done really, really well. That's why I should invest in this stock. And basically, that's the basis of this strategy, and that's exactly why it's not a good strategy. That doesn't mean that past performance can't be used as part of the evaluation of an overall investment, whether it's good or bad. However, this strategy is supposed to say that solely entirely based on past performance would be the indicator that it's going to continue to do good. Yes, there are some things that in the past do good that are going to continue to do good, but it is no way a guarantee. This is not a guarantee. That's not a good mindset to go into when you're investing. For example, there'll be a lot of companies or industries that come in with a big bang and they make tons and tons of money on their investments, and they go out with a big bang as well and they lose tons of money. Now, an example of this would be the tech.com boom that happened. A ton of people were making tons of money off investing in this, and most of the companies fell through. Now, obviously, some companies survived and they're still around today, but the majority of the times in a new market, there's lots and lots of people getting into that market because it's making so much money, but most of the people do not survive. However, like I said, past performances can be taken into account when assessing whether an investment is good or not. If it's gone through really good times in the market and really bad times in the market, and it's held up pretty well compared to the overall average investment, then it's still probably a decent investment to get into. But in no way does it guarantee that it's going to continue to do well in a bad market in the future. As well, when you're trying to assess what has had good past performance previously, you do not want to be assessing two different investment types. If you're not supposed to compare a bond to a stock. They are different types of investments. You want to compare bonds to other bonds and stocks to other stocks. And as well, if you start comparing stocks to bonds, you're never going to end up investing in bonds because they usually don't make as much as stocks. But that doesn't mean that there's no place for bonds in your portfolio. It just means that stocks usually make more, and so that's why you compare stocks to stocks and bonds to bonds. And when it's coming to risk analysis on which ones are riskier, you can compare that in a different sense. But when you're like, I'm going to focus on stocks and what stocks I should buy, focus on stocks. Don't wander on to other types of investments at that point. But that doesn't mean you shouldn't have different types of investments. And when you're assessing past performances, the most recent past performance is even less of an indicator of a stable investment than would be the further past. Because like I said, in the further past, there has been market downs and market ups that you can use to help evaluate it. But in the recent past, there's not so much of that, especially like if, oh, last year this one made so much money. 1 year is not a good time frame to assess any type of investment. It's really hard to tell whether recent good performance is there to last. Sometimes it's just good luck that got that stock there in the first place, and good luck doesn't always keep a stock high. So kind of as a small review at the end of this video, past performance is not the only indicator you should use ever to buy stocks, but it's still good to look into. Do not go chasing high returns because you're falling behind usually, and oftentimes they will go back down. If you find these videos interesting and informative and you want to learn more, please click subscribe, as I will be uploading videos every Monday, Wednesday, and Friday. Have a good day. Bye.